I was really struck by my surroundings. The poor were truly poorer than I had ever seen. People with tattered shoes and tattered clothes, broken limbs. What these people needed was less so health and more wealth. They needed a means for advancing out of this poverty. They needed liquidity. Markets are the way to drive prosperity and economic growth. And he gave me lots of reasons why. One is equity markets as a tool for wealth distribution. It's a way to ensure that the people within companies are participating in economic growth. Global Delta Capital, we're a long-only emerging and frontier market investor. Our core offering is an emerging markets all-cap strategy, both with and without China. And ended up taking a senior portfolio management role across emerging market strategies and launched the first quantitative frontier fund, launched the earliest set of emerging market small cap strategies. I had the opportunity to launch the first emerging markets fossil fuel free fund that was managed in an active institutional context.
Hello, Asha. Thanks for coming on the show today.
Scott, I'm so excited to be here. Thanks so much for hosting me.
You are a self-proclaimed adventure capitalist. I've had all kinds of professional investors on the show. I've had venture capitalists on the show. I've never had an adventure capitalist on the show. So I'm really super anxious to get into everything you're doing today. So you've had quite an interesting path. And your story starts somewhere in Gainesville, Florida, described often as one of the most beautiful in Florida. Is that true?
Thanks so much for this wonderful introduction. And I'm happy to start with Gainesville. It is beautiful. It's lovely. Highly recommend. And it was really quite a fortunate place to be born and to be raised.
You're raised by two research physicians. Your father was born in pre-partition India. Your mother is a daughter of Russian and Jewish immigrants, I think, and your grandparents were refugees from the partition in India. So tell me about your childhood environment.
Gainesville was a fortunate place to grow up in, especially given the backdrop of stories that I grew up with. Gainesville, my parents were professors of medicine. Gainesville is a middle-class town, a university town, in the heart of the Bible Belt in North Florida. So relatively peaceful place, and perhaps, a little bit leaning toward the progressive side, given that the university is based there. And again, what a fortunate place to be born with the backdrop of what else was going on in the world. So as you say, my parents they come from refugee families, and they found themselves in medicine and in academia specifically because they were both raised with this notion of solving for stability, that the world is an incredibly volatile place and people can lose everything all at once. And a pathway to stability and a comfortable livelihood, they were both taught, even though they were raised from people in different parts of the globe, that the pathway to stability is education, and specifically medicine. So I was raised, again, in this very stable environment, but with these incredible stories in my background, from my mother's side, what it meant to be fleeing Europe in the 1940s. And from my father's side, some really horrific stories. He was born in pre-partition India, as you say, on the Pakistan side. Family was Hindu, and they were forced to leave Pakistan at gunpoint. So he has memories, of being a young child, just having crossed the border, growing up in refugee camps, literally in ditches, no electricity. He went to his medical school interview with a jacket that he borrowed from someone else and just the front of a shirt. Didn't even have the means for an entire shirt. So it was never lost on me how fortunate I was to be raised in this idyllic town. And I was always moved and enthralled by their stories. So when I went to college, they certainly encouraged me to follow in their footsteps, a pathway in medicine. And I'm here today, so I didn't end up pursuing that.
Right. Then you went to Eastside High School in Gainesville and was in the International Baccalaureate program. Tell me about that.
It was such a fascinating program. I think IB is pretty well known and well recognized internationally, and it tends to be fairly regional here in the U.S. But the IB program is such a cerebral environment. Again, Gainesville itself is a university town. And many professors would actually go and teach in the IB program in my high school. Gainesville, like I said, the heart of the Bible Belt and truly the South, especially a generation ago. Florida's transformed in the last generation. But then very much a city that struggled with race relations. We were taught every year throughout elementary school and ongoing about race relations and the history of Alachua County and Florida, in the context of the civil rights in the last 100 years. And I think just having that sense of responsibility, that progressive environment, access to these incredible teachers or professors made for an incredible curriculum. So it was international by nature, again, university town that attracted people from all over the world, but mostly an international curriculum that again, kind of infuse these themes around social responsibility and academic achievement.
And then from there, you went off to Stanford, following in your parents' footsteps in pre-med, but also something with anthropology, a separate track. That's not an obvious one. So tell me about that.
Yeah. So again, it was somewhat of you mentioned IB and the fact that it was very broad-based curriculum. I chose Stanford, or Stanford chose me, I should say. But I had my heart on going to Stanford in part because it had such an excellent broad curriculum. And I just was kind of undecided. Did I want to do the sciences? Did I want to do liberal arts? I certainly had the pressure from my parents to do medicine for the reasons I said. So dutifully, I studied biological sciences and got my bachelor's of science in that field, which tended to lean a bit scientific. So there was actually a pre-med major. I leaned toward the version that was much more based in genetics, which was a field that was advancing very rapidly at the time that I was at Stanford. And I bring that up only in the context of where I think this conversation will go around, using data science tools in the investment space. But I developed a background in that time in programming and optimization through the science degree. But separately, my heart, as I've been saying, was in understanding my parents' backgrounds and feeling close to those around me. What I should have mentioned previously when we were talking about my childhood was I spent a lot of time abroad. My parents both worked full time. They didn't have summers off. So they would ship me off to remote corners of the world to go get to know my family. So I spent many summers in rural India, throughout Europe, and spent a good bit of time alone, and also a good bit of time surrounded by people who looked different, thought different, spoke different. And that made such an impression on me. So when I went to Stanford, I longed to experience, some of this international relations. I wasn't sure what to call it, and anthropology, I suppose, called me. It was the study of people all around the world.
While you were at Stanford, you decided to field test your dream of serving the impoverished, and you went to India on a vaccine distribution project. But then when you got there was a sequence of events that happened that it seems that your life took a major turn.
Yeah, thanks, Scott. It was truly an epiphany moment. I mentioned I'd spent a lot of time in India previously, and yet I was so enthralled by the stories of my past. And so while I was at Stanford, I had the opportunity to travel abroad, go to India, and I thought do it all, do a vaccine distribution project in line with my parents' wishes around medicine, but really be on the ground and see that the work that I was doing would have tangible impact. And I remember telling my father I didn't want to go back to stay with family that I had been raised with and who I had spent time with before, but I wanted to go to the poorest parts of India and really be in the heart of where there was most need for development. And he said to me, you don't know how poor the poor can be. So I stayed with a homestay family. I went to Lucknow, India, in the state of Uttar Pradesh, UP. It's one of the very poorest states in India. And I was seeing India with all new eyes now. I wasn't staying with people I knew. I wasn't visiting a place I had been. I landed there and was pretty overwhelmed with the sense of what I was getting into. I quickly learned in the first couple of days of landing there that the vaccine distribution project was canceled, that the funding for that project was no longer there, and so I'd have to go figure out something else to do for that summer. And, again, here I was kind of taking a deep breath, trying to figure out who I was and what I was going to do, and learning that I had nothing but time ahead of me. And I was really struck by my surroundings. The poor were truly poorer than I had ever seen. I mentioned my father with just the front of his shirt. And that was consistent with what I was seeing around me. People with tattered shoes and tattered clothes, broken limbs, beggars. And it occurred to me that really what these people needed was less so health and more wealth, that they needed capital, they needed money, they needed a means for advancing out of this poverty. They needed access to capital to help them build businesses and make more money, and they needed liquidity. Again, this wasn't my background. I was here a complete novice with only an academic background, having studied anthropology and medicine, but it just struck me that money makes the world go round, and these people needed it more than anyone. And so we didn't have ChatGPT, we didn't have Google at the time. I didn't know what to make of all of this. So I literally thought, these people need access to funds. I would like to work for a bank for the summer. So I went to the phone booth and I looked up bank in this tattered, phone book, and I found the Bankers Institute of Rural Development. I thought, well, that sounds kind of interesting and certainly in line with what I want to do. Again, I only had 4 words to base this assessment on, but I hired a rickshaw, and the rickshaw took me out to the end of the city, got in a tempo, one of those little 3-wheelers, kept going and asking in very broken Hindi, how do I get to this location? I ended up walking pretty far into this remote area on my own. And I soon realized that it was a microfinance organization. This was the late 1990s, just before Muhammad Yunus had won the Nobel Prize for his work in microfinance. And I'm happy to talk more about that experience, but I'll pause here for a moment.
That's where you got your first taste in microfinance. You went back to Stanford at the end of the summer, and then you graduated and landed at Goldman Sachs as an investment banker. So medical school to iBanker, explain that.
Yeah, microfinance, the original impact investing. I spent the summer there. They ended up hiring me. I worked for free, but they let me work for them for free, filling out databases for them. I knew how to use a computer, so I could build very simple Excel charts on, what microloans would do for people. And I would log $10 for a sewing machine, $20 for a cow. And then I would go with them into the villages, way out past, the roads, past the dirt roads, into the forest. And as we would distribute these funds, in rupees and tattered rupees, my Hindi is very poor, so it was mostly visceral. It was mostly seeing, what these rupees would do for these women. It was all women in borrowing groups. I could see we were helping them build financial independence, helping them support their communities, helping them really build the next sectors that India would come to grow on. I was impassioned. That was it. That's why I say it was an epiphany for me. So at this point, it's 1999. I'm about to graduate college. It's the heart of the tech boom. Stanford is in the heart of Silicon Valley. People I knew not only were looking for jobs in technology, but they were dropping out of school left and right because they wanted to get into this nice tech boom that was occurring in Silicon Valley at the time. My heart was in using this investment capital to really drive development. So I had no background in finance. I had no background in economics, but perhaps there wasn't much competition given what was happening on the West Coast at that time. I went to the banks on the East Coast. They were hiring. They were looking for talent that was hard to find in that environment, and they hired me. So I was thrilled to join the banking group. I worked in the energy and power group, later named natural resources, and today, of course, includes cleaner technologies. But it was a great place to land because I got strong background in fundamentals, finance, and I got to continue my work in international project financing.
And then I think that only lasted a couple of years, and it seems like you went to Wharton to pursue an MBA.
That's right. So I was at Goldman during 9/11. So the events in New York sort of expedited my transition. I think, like a lot of people, banking is a wonderful place to have been, a great training ground to have done. But when you're in the throes of it, it's certainly a really challenging experience. And throw on top of that the events of 9/11. I was eager to get my bearings, get a more solid education in finance and economics. Wharton was building their program in social impact. It's pretty impressive what they've built out today. Has an incredible international community, and I jumped at the opportunity to go get my MBA at Wharton.
And then somehow in the middle of that, you did something at INSEAD.
I did. I spent a summer there. So Wharton and INSEAD have an exchange program. I spent a summer in France. I wanted to go to Singapore and experience this incredible growth in Asia, but SARS had broken out. I ended up going to France instead and had an incredible summer, built a wonderful network, and was pleased to have the opportunity to study there as well.
Then you got out of business school and landed at Centocor.
Centocor is a biotech shop. So again, I had this background in healthcare, studied biology, had been raised by doctors. International development called me, but I wondered, and this will be a theme I'm sure we come back to, what does it mean to have a career in international finance? And I know, Scott, you live all around the world, and so you have a good sense of this. But as I thought about what is my career going to evolve into, and how will I be able to travel all around the world, in the context of having a family and managing it all, I thought about, well, maybe I'll try a stint in healthcare again and see if that gives me some bridge. Again, I had spent some time in New York during 9/11, and I thought I could use a little more stability in my life. I ended up spending a couple years there. They were quickly acquired by J&J. And it was a good experience, learned a lot about the healthcare industry, but I really missed, the opportunities around financing development.
So that's when you landed at Acadian Asset Management. I guess that's in Boston, staying there quite a number of years. So why investing?
Yeah, I had a wonderful experience there. Again, I was at J&J at the time and feeling like I wanted to get back into international finance. And I came across a story in the Wall Street Journal that they were launching a frontier fund. So a fund that invested not in China, but Vietnam, and not in South Africa, but Botswana. And they were doing so with data-driven methods, which enabled them to have a very broad universe of coverage. I thought this is really interesting. Cold called the leadership of the firm, and literally 6 weeks later, I started there, and it turned out, as I said, to be a terrific experience. Worked for a founder and had the opportunity there to sit in a few different roles, including being a researcher and testing out some of the ideas I had built in my time and energy and my time in healthcare, and using data-driven methods to invest in these sectors I found was incredibly rewarding. So I spent a good bit of time in research, quickly went on to lead the frontier market strategy that had lured me to the firm in the first place, and ended up taking a senior portfolio management role across emerging market strategies there, and launched a series of first emerging market funds. So that frontier fund was the first in the market, certainly the first quantitative or systematic frontier fund. We launched the earliest set of emerging market small cap strategies. I had the opportunity to launch the first emerging markets fossil fuel free fund that was managed in an active institutional context. So I mentioned two of the three kind of main roles I had there. One was research, another one was running emerging market strategies. But the third was on the sustainability space. And of course, another reason why you and I are sitting here today. Back in 2009, the firm was approached by some of their European clients and asked to sign the PRI, what was then called the UN PRI. And the founder asked me to look into it. And I said, hey, I think this is an interesting research area. And at the very least, it's an interesting growth area we should sign. It brought us to become the first quantitative investor to be a signatory of the PRI. And it was just an incredibly informative educational experience for me to be an ESG investor in the earliest days of the movement, just around the time that ESG as a concept was even coined. So we can get into, what does it mean to be a systematic, sustainable investor? But I had a tremendously, incredible experience there across those three roles, using data-driven methods to identify signals, running emerging market strategies, developing a sustainable strategy, and ultimately felt, we live in the era of big data. emerging markets are mainstream in every way except investor allocations. And so this in and of itself is a growth area. And sustainability carves out a blueprint for the earth. This gives us a framework to think about, what are the secular changes that are recreating the opportunity set, a new way to think about where is their alpha. And I thought perhaps it makes a lot of sense to build a boutique around these ideas. So I've probably jumped ahead where you wanted me to go, but
while you were at Acadian, you were one of the first people to launch an onshore China strategy, and I guess based out of the U.S. And I think that was around 2018, just around the time that Trump launched a trade war. So that must have been interesting times.
Great timing, right?
Yeah, timing is everything.
Yeah, right. So I mentioned I was externally designated the lead on all of their specialized emerging market strategies, including the China A Fund. You're exactly right, Scott. It was the second onshore China A Fund here in the U.S. So it was a U.S. vehicle. Very exciting time to be launching a strategy. Clearly the headwinds were real, trade war, tech war, and fast forward a few years later, those kind of headwinds against the country have certainly played out. The other side of that, of course, was this incredible liberalization that China was going through. I mentioned a few times frontier markets is an area that I just find so interesting to invest in part because a lot of investors don't. And not only is it intellectually very stimulating, but from an alpha perspective, from a return perspective, because you don't have institutional participation, it's much easier to separate the winners from the laggards, and it's a great place to be a stock investor. China in 2018, and quite honestly still today, has that profile where it's a great market for stock picking. However, it also has the breadth and the scale of the US. So you take this narrow opportunity in frontier markets, but the incredible alpha, the incredible inefficiency, and layer on top of that the breadth and the scale of the US. It's a stock picker's dream. So, kind of the push and the pull, it was, the great opportunity at that time was the alpha. And of course, the headwinds have been real as well.
I just want to quickly mention that you sit on the boards, or you are an advisor, or are involved with in some way a number of other companies and organizations, CFA's Society Boston and Compass Working Capital and High Meadows Institute and 100 Women in Finance. Can you describe what these organizations are and why you join them and dedicate some of your precious time to them?
Yeah, thank you. Those are all organizations that mean so much to me. I'd say the overarching theme is around financial empowerment, access to finance, access to financial education, and that comes across the spectrum. So Compass Working Capital, the thesis there is around access to capital for those who are looking for pathways out of poverty. And contrast that to 100 Women in Finance. These are women who are in the industry and are looking for, parity in the industry effectively. And so across the spectrum, there's just tremendous opportunity to bring more people into this incredible space around finance more generally.
And in 2020, you founded Global Delta Capital, a long-only emerging markets equity manager. What motivated you to jump out of Acadian and create your own firm instead of implementing the strategy within a existing asset management organization?
Well, again, I sat at the junction of, a few secular themes that I really saw as the mega themes that redefine the opportunity set. The rise of data or the rise of AI, machine learning, whatever you want to call it. Looking at emerging markets, you mentioned I had just done all this work on the China Fund, and it was palpable to me, just the incredible growth opportunity outside of the US. Today, 2 of the 3 largest countries in the world are emerging market countries. I'm sure, people are aware of the statistics around how much of the global footprint is not in the developed markets, how much of the global population is not in the developed markets, even the productivity that's not in the developed markets. But even if you just look at the top 3, or if you look at the headlines, it's palpable how mainstream the emerging markets have become. Again, like I said before, in every way except investor allocation. So that strikes me as there's the beta, like there's a reasonable case to be made that there's likely to be a flow of assets into this asset class. But between data-driven, the emerging markets, and looking at sustainable investing as a pathway to alpha generation, I thought this is really interesting. I've covered this asset class for a couple decades. And it's a unique asset class, especially for sustainable investors, because it presents an opportunity for investors. It's not at all concessionary. It's so inefficiently traded. So there's outsized opportunity for alpha. But given the low base effects, right? Given the low base of development, there's also outsized room for impact. And I thought, well, what an incredible opportunity to make the case that sustainable investing is not concessionary in nature. In fact, it's highly additive. So I thought I'd build this boutique, and the thesis behind it is it's an asset class that's rife with opportunity with respect to both alpha and impact.
You've described the opportunity, but you haven't exactly explained why you couldn't do what you were trying to do from within a larger asset manager that arguably has more resources. And I think there's other firms that compete with you that have long only frontier market funds like GAM and Polar Capital and Kepler and ABS Global Investments. There must have been something else that made you want to start your own shop.
Yeah, I mean, I think the investment strategy is quite novel. The feedback I've gotten, and these are very valid comparisons, Scott. I think what's pretty unique around this strategy is the fact that it's a systematic implementation. It's highly data driven. So the way we identify investment opportunities is using an objective framework for evaluating 15,000 stocks across the globe. So we've got a very systematic approach to security evaluation, to portfolio construction, to risk management. That's a proven method. Again, reference my experience in the time at Acadian and launching a series of innovative, first or second to market strategies, and seeing that using the systematic approach is just incredibly effective in producing alpha. So I think with respect to emerging market sustainability strategies, the systematic approach is unique. And with respect to emerging market systematic managers, the sustainability approach is unique to really use that power of capital thesis in driving our investments to understand that there is an ecosystem that effectively we're funding when we allocate capital. It was really important to me that ethos around being an intentional investor was infused in the investments. So, I was coming from a terrific shop that had a terrific process. Here at Global Delta, the opportunity was to really sit squarely at that junction of systematic, sustainable, and emerging markets.
You had a vision that not everybody else had all of those ingredients. You had a vision for pulling all of that together that you didn't really feel that larger asset managers had that.
That's right. So bringing through that brand and that ethos, I thought was really central and key. And I've had the great fortune in forming Global Delta of having a number of former team members join me. So we have a terrific team on the investment side. It's effectively entirely former colleagues from Acadian.
Using public equities as a vehicle for impact might strike some people as not obvious.
Mm-hmm.
You're changing shares on secondary markets. But I think you concluded differently once when you were in Romania.
Yeah. I think you're exactly right. I often hear that public markets is not the desired asset class for driving impact, that it needs to be private equity. And I think there are just two sides to that thesis. And again, part of the thesis around Global Delta is we strive to create some level of impact through our investment strategy, which is in the public equity space. And the epiphany with respect to using public markets as a vehicle for impact came when I was traveling the globe, which I think is somewhat unique for a systematic manager. Again, highly objective, process-driven approach. But I do think it's important as investors that we spend time on the ground in the markets in which we're investing, give us more of a perspective on what are the secular themes that are reshaping the opportunity. What data sets do we not have access to? What risk are we not including? Set of parameters. So I do tend to spend time across the globe and visiting regions from time to time. And it was on a trip to Romania that I was sitting with the head of the IMF, which was somewhat unique as well. I think IMF representatives are more accustomed to speaking with fixed income investors or credit investors. And he was very warm and very pleased to see me. And I think because I was bringing this equity capital market strategy to him and picking his brain on what's the opportunity for Romania. He explained to me that this was a country in transition, making the shift from hard communism to hard capitalism. And I could see that before my eyes. Romania is a fascinating place for those who haven't visited. It's still got very palpable relics of the past, the fact that people speak in a whisper and the glittering castles. But that hard capitalism truth is very much palpable as well. It's, a central exporter for much of Europe, creates a lot of the technology that, informs all systems today, automotive, healthcare, and even investment technology. Many of them come from Romania. So the IMF director was sharing with me why he was so excited to be hosting an equity capital market investor. And he said to me, markets are the way to drive prosperity and economic growth. And he gave me lots of reasons why. One is equity markets as a tool for wealth distribution. Romania is an interesting country because they use the public markets as a vehicle for reparations. So during the communist regime, when many assets were, taken by the state, those now sit in a fund that's been distributed to the people of Romania. So one tool, they're using the equity capital markets to enable the population to participate in corporations' growth. So as companies become more liberalized and grow more, the local population will benefit. Another point on wealth distribution through the equity capital markets, it's a way to ensure that the people within companies are participating in economic growth. So this idea around employee stock plans is one tool for wealth distribution. That's one thesis around how equity capital markets can drive change, and I'll mention three. The second one is around, being a liquidity driver. In developed markets, I think the thesis around equity capital markets as an impact driver through financial additionality, I think that's somewhat flawed because there's tremendous access to liquidity in the developed markets. But if you're in the frontier markets like Romania or the small cap side and emerging markets, these are companies that are typically starved for capital. So to be a liquidity provider to companies that are creating innovative products that are perhaps SDG aligned or exhibiting responsible sustainability practices, that is a tool for change. But the third reason, I mentioned wealth distribution, liquidity infusions. The third one I think is really the most palpable and speaks to systems level impact. As equity capital market investors, we need data all the time, right? We need data quarterly, at least semi-annually. And his biggest thesis was that it's just essential to shed a spotlight on what's going on with sources and uses of capital within companies. That the central way to stamp out corruption is to force companies to report on their financial statements, to show the sources and uses of their capital. That the strength of a market mechanism is the unrelenting transparency. And I've seen that over and over as, again, these capital-starved businesses come to market and seek international capital and seek institutional capital. Typically, the disclosure standards are well ahead of traditional emerging market standards and oftentimes ahead of developed markets in and of itself. So again, it's somewhat of a different thesis, but very palpable to me if we're looking to stamp out bribery, stamp out corruption, and bring the standards in emerging markets in line with those of developed markets.
So let's start with an overview of Global Delta Capital. Just give a high-level introduction to your company.
Yeah, sure. So Global Delta Capital, we're a long-only emerging and frontier market investor. We are able to run a series of specialized strategies around country-specific implementations. But our core offering is an emerging markets all-cap strategy, both with and without China. Our investor base is comprised mostly of institutional investors, including family offices. We currently offer commingled vehicles as well as separate accounts.
You have emerging markets all cap, you've mentioned, then there's an emerging markets small cap equity.
So the strategies we offer fall across the emerging market spectrum. Our live strategy is an emerging markets all cap strategy. We can offer an ex-China sleeve or a variation that includes China. And we have capabilities to develop all variations within emerging markets, whether that's country-specific strategies, emerging markets, small cap, frontier. But the live vehicle we have today is in the emerging markets all cap space.
And is that one fund or is that two funds?
We offer one fund and two sleeves within the fund.
Is that open-ended or closed-ended fund?
This is an open-ended fund. We offer monthly liquidity.
Do you have other stats?
Yeah, sure. Happy to share some overview of the portfolio. Emerging Markets All Cap Strategy benchmarked against the MSCI Emerging Markets Index. Because we cover such a breadth of securities, like I say, 15,000, and we're looking for outsized inefficiency, we tend to find a lot more alpha opportunity on the small cap side of the spectrum and off benchmark names, whether those are companies that are not included in the benchmark, or if it's countries that are not included in the benchmark. So a pretty high active share on the order of 90%, and significant exposure to the small cap side of the spectrum relative to benchmark exposures. Across countries and regions in the emerging markets, we're highly diversified. We see opportunity at the stock level across regions. At the moment, we're certainly favoring Asia and happy to speak to some of the rationale there. But we see incredible opportunity across the Gulf, across Eastern Europe, a little bit more muted on Latin America at the moment, although there are some stock-specific opportunities there that are interesting as well. Tend to be very diversified across sectors and quite dynamic. I do think again, I've mentioned the SDGs as carving out a pathway for global growth and secular themes for the next couple of decades. So at the sector exposure level, where we have some themes that are particularly interesting are on the consumer side, the technology side, and sustainable infrastructure.
What is your total AUM?
Managing approximately $100 million in assets.
What's your theory of change and your investment philosophy behind your portfolio construction?
In terms of portfolio construction, I'll tackle this both from an alpha generation perspective as well as from an impact generation perspective, right? So what makes the asset class so interesting is there's outsized opportunity for alpha and for impact. And these two themes are mutually beneficial as opposed to concessionary to one another. From a portfolio construction perspective, again, we're using a systematic approach. We're using effectively an optimization method, and the objective function, the goal, the objective is literally to maximize returns, subject to transaction cost and subject to risk controls. So from an alpha perspective, our objective is to truly maximize the return opportunity, which of course in emerging markets includes some significant diversification of risks at the country level as well as stock level. On the impact side, the theory of change and the thesis around what we do is multifold. Number one, we see sustainability measures as alpha generative. We see that by investing in companies that are well governed and have strong environmental and social practices across the globe, those types of companies will outperform. In the emerging markets, where there's more dispersion on these types of themes, we actually see the payoffs to sustainability factors to be twice as high. And so investing in companies that have strong practices with respect to these sustainability themes in and of itself is a way to improve returns. However, our strategy is about more than improving the returns of the company for our investors, but also by delivering some level of impact. And so from an impact perspective, our objectives are twofold. One is to provide that financial additionality, which I spoke about before. So to find companies that are capital starved, that have needs for more liquidity, that are performing well with respect to sustainability, or I know ESG has become a four-letter word here in the US, but these ESG factors, to be able to fund companies that not only have strong ESG practices, but are also developing SDG-aligned solutions. So that to the extent we can be a funder of those companies, that's delivering a level of impact with respect to financial additionality. But the value additionality comes through our stewardship practices. And I think stewardship practices, as we talked about in the case with Romania, pretty significant in emerging markets where we can drive that system level change and improving disclosures, improving transparency, improving accountability across parts of the market that are looking to really evolve into the global capital spectrum of flows.
Let's be clear, you're a quant fund, and this integration of sustainability and ESG factors, I guess, depends on having good data and somehow incorporating all this into some kind of model here. This is kind of unusual being applied towards emerging markets and frontier markets where you got pretty thin markets. So let's try to drill down a bit more in the weeds. I'm going to ask you to explain what quantamental investing is. And I remind you, you're talking to a guy whose girlfriend did all of his statistics class homework for him in university. Okay? So easy on me.
I don't want to make this overly mystified. I see the quantitative approach that we utilize as simply an objective implementation of fundamental themes. So a fundamental investor wants to invest in companies that have good growth prospects, that have strong financial statements that prove that the company has the balance sheets and has the management quality to support that growth. So that good growth, strong quality companies. The valuations of these companies are attractive, meaning that there's some upside in the stock price. And then finally, there's some technical support that this is the right time to buy into one of these securities. So the systems that we're using have basically built factors or signals along those themes. So we, just like fundamental investors, are looking to invest in companies that have good growth prospects, strong financial statements, strong management teams, attractive valuations, and some support for the stock price. And again, the systematic approach simply tries to objectify that. And by using this objective process, it gives us, I think, a real significant advantage in investing in emerging markets. Number one, because we can target a breadth of opportunity. If we've systematized the analysis, we can create that framework and run it literally across every single stock that prices. So every stock in China, we've got a forecast for. Every stock in Vietnam, we've got a forecast for. And that's imperative. Again, having coverage of the smaller cap side of the spectrum gives us access to information of stocks that other investors aren't following and therefore likely have a more attractive mispricing characterization. Likely there's more upside in those stock prices. Another hurdle in emerging markets, of course, is foreign ownership limits and transaction costs, liquidity, these operational hurdles that are very real. Having a breadth of coverage enables us to tackle those hurdles. So this objective approach enables us to cover a very broad universe of stocks. Number two, it enables us to be very disciplined. So I'm sure your listeners are hearing about us investing in emerging markets, and it often sparks a lot of fear. I mentioned EM is mainstream in every way except investor allocations. I think the reason is investors are concerned about the risk profile in emerging markets, and rightly so. Country by country, there can be tremendous volatility within countries. And I said, emerging markets are often in the news. It's often not for good reasons. It's often to highlight risks. And so having a disciplined process that tells us this risk has been overestimated, or the country looks fantastic and the secular themes are so exciting, but that's been priced in, and this is a good selling opportunity. Having the discipline that comes with a quantitative approach in markets that can be very volatile is an advantage. And then thirdly, on the why a quant approach in emerging markets, and again, I get the skepticism. Can you really apply data sets to companies where you haven't talked one-to-one with the management team yet? How can that be effective? Trying to walk through the value of a broad universe, the value of a disciplined approach, and finally, the value of using this holistic, or what some people call a multi-factor process. The fact that when I'm evaluating a security, I'm not only thinking about what's the growth prospect and what's the financial statement support and what's the company governance like and what's the valuation, but we can layer onto that what's our macro view for this market. We can layer on top of that what is the liquidity profile, what's the transaction cost profile. To do that across 15,000 stocks, it's simply not possible in fundamental space. That's kind of the high level on why a systematic approach and how a systematic approach works.
How did you build the model?
So again, I've been in this space for about 15 years and have my own background and history in running systematic strategies. And I've just had the tremendous fortune of pulling together a team that has incredible skill sets. I mentioned my team is a team that I've worked closely with in the past, and they bring tremendous skills and accessing data and cleaning data and developing factors that are predictive of return, combining factors, weighting factors. Each of these measures requires, some level of expertise, and I'm just honored to have a team that brings that talent to this organization.
It's hard to contemplate how you have one systematic model which is localized, but flexible enough to accommodate all the different emerging markets because they're so different.
Yeah, no, you raise a really important point, Scott, around the importance of localizing models. When I began my experience in systematic investing, emerging markets was a bolt-on asset class. It was a very small asset class. It was considered completely opportunistic. It wasn't mainstream in any way. I think currently I've said over and over that investors are under-allocated to emerging markets. I'd say, typical allocation seems to be on the order of 5 to 10% of an investor's portfolio. When I began investing in emerging and frontier markets, it was entirely opportunistic. It was, below sort of the levels I just mentioned. And my experience over the last 15 to 20 years, and part of what led me, to found Global Delta, is that these countries have truly emerged. Back when I was launching the China Fund, one of the most common questions I would get is China even an emerging market? Like, hasn't it reached developed market standards? Young people in China today have never known a life of poverty. Like, what is it that makes it an emerging market country? The reality is, I've said this before, the breadth and scale of China relative to the US. China and India each alone have as many securities as the US does. And you think of how many US specialists there are. My view is not only does emerging markets stand alone as an asset class and need tailoring for the investment strategy, but country by country, the dynamics are so unique. What's driving China is night and day different from what's driving India. And so what we're looking to bring here at Global Delta is not only a strategy that's specialized for emerging markets, but brings specialization on China-specific drivers, India-specific drivers, the Gulf, Latin America drivers being unique as well.
Do you have a split between the fundamental versus the quant side of your investment process?
Yeah, you mentioned the quantamental. When I hear quantamental, sometimes I bristle because it means different things to different people and often has a negative connotation. But I think it's such a popular term because it speaks to the importance of both sides. And we're certainly believers in this. I mentioned all of the strengths of a quantitative strategy, the breadth and the discipline and the multi-factor approach. But of course, there are some instances that quants can't, that models are not equipped to handle. I was investing in Argentina when Christina Kirchner started nationalizing businesses. Literally, she would just take over a company overnight, sending the value of that company to zero. So the value for stock investors was literally wiped out. Fortunately, there aren't enough examples in history of countries that keep nationalizing, or readily accessible countries that keep nationalizing businesses. And there's certainly not a robust sample of companies that have been nationalized. So how do you build a statistical model around nationalization risk? You cannot do it robustly. There just isn't enough sample. There's not enough examples to work with. Similarly, what's happening with China in terms of the geopolitical risks, in terms of the market interventions, these themes can't be modeled because there's not enough history to develop a robust enough, a statistical assessment. The SDGs I've talked about as a roadmap for what secular growth will look like. That's a forward-looking theme. So how do you back test that? I think requires some innovations and sort of the mathematical tools that are applied. So we at Global Delta, and I think effectively all quantitative investors, you're making judgments, you're making assessments. It's man that builds the machine or woman that builds the machine. The assumptions that are put in at the front end just are really critical. That's ultimately what drives investment capital. I'm fortunate on our team not only to be surrounded by individuals who have a very robust background in quantitative and statistical tools, but our team also includes experts that live in the emerging markets, bring local expertise to our investment strategies, ensure that the models are built to account for these secular themes. And, we see the importance of stewarding the process. If the models are telling us to invest in a country, where we just see outsized risk and we know the models are not equipped to account for that risk, we reserve the right to override the model and influence that judgment or discretion.
Do you have a distributed organization, or is it all in Boston?
Yeah, we were born in the pandemic, as you mentioned. For late 2020, we got the founding paperwork in place, and we've been building over the last couple of years. And so that's enabled us to build an entirely cloud-based environment and in a distributed environment. So headquarters is in Boston, but we're based all over.
How many people do you have on your team?
We're 11 people in total.
Let's move to the sustainability side, which you've integrated into this systematic modeling. It's difficult enough to get reliable sustainability data in developed markets. It's just got to be even more difficult in developing markets. So where do you source your data from, and how do you ensure its reliability in developing countries?
Well, to be clear, before I answer you with great conviction around the strength of our data sets, I certainly want to clarify that is part of our theory of change, right? Part of our objective is to be stewards, to call for more transparency and more standardization, and to really support companies in their journey toward better data, that ultimately more informed data or more transparent data will make for more informed investors and therefore greater pools of capital that can invest in these companies. So I think the case for companies, industry groups, regulators to adopt these transparency practices is clear enough. We've certainly seen adoption in sustainability stewardship codes across emerging markets, but there's still a journey, that needs to be taken to adopt these methods. So in the interim, how can we be comfortable with the data sets that we utilize? I'll start by just saying I do agree that country level data can be spotty, can be limited. Company level data can be quite robust. And I alluded to this before, that as companies are looking to come to market, some of these disclosures are just unparalleled, even relative to developed markets. I'm thinking specifically with respect to the SDGs. So many companies and many countries in the SDGs receive funding. They receive multilateral funding that is aligned with the SDGs. So they've got a different reason to be transparent and to disclose with respect to SDG alignment that is truly tied to their sources of capital. So we actually find information sourcing on the SDGs to be robust enough. And I would say that ESG, environmental, social, and governance data in emerging markets, probably better than most people expect it to be. When I say better, I mean in terms of coverage, governance data. There are many, many ways to measure governance. Some of the tools that we think are highly correlated with traditional notions of governance are just readily accessible. So we find very high coverage of core governance measures. With respect to labor practices, with respect to product safety, with respect to many notions around environmental considerations, company reported coverage is okay. And we get a lot of value out of utilizing alternative sources to augment that data. So parsing headlines, parsing data from NGOs, using natural language processing. These are systematic, data-driven tools that are really effective in terms of extending our coverage. So overall, we find that coverage is again, greater than what investors think, especially by the companies themselves. If you're looking for a parsimonious set of indicators, and augmenting that through systematic means gives us sufficient coverage to make an assessment of companies from a sustainability factor perspective.
Tell me how you construct your portfolio, your end-to-end investment process, what that looks like. And I guess I'd like to start with, how do you define your investment universe? And then it's on to the screening process, both financial, non-financial screens.
Happy to do a process overview. Excited to. The investment process, you mentioned quantamental. I'd say it begins with a fundamental look. It begins with understanding what are the secular drivers, what are the mega themes that create opportunity today. And I've walked you through many of these, which countries we see opportunity in, what are the drivers, the demographics, the SDGs. Ensuring that these types of signals are built into our process at the front end enables a more streamlined process downstream from there. So the process really begins with kind of that fundamental assessment. At that point, we have a model effectively with a set of about 20 signals that we've researched that we believe are predictive of forward return. And they fall into the categories I talked about before. These are signals that tell us, what's the growth potential for these companies? What do sell-side analysts think? What's their history of earnings growth? What is their alignment with SDGs? So a number of growth-related signals, a number of signals I talked about before. What's the financial strength of these companies, the management quality? What is the valuation profile of these companies? We'll look at this through a sector-specific lens, knowing that valuation by sectors uses different tools, and the technical side as well. So we're doing, again, the first step is to have that secular view. The second step is to define the set of factors that we're going to evaluate every company on. And this model incorporates not only what is the factor itself, but what's the relevance of that factor within that country. So you mentioned localizing before. China tends to be a very sentiment-oriented market. Africa tends to be a longer traded market. Liquidity is harder to come by. Those value factors are very, very effective at forecasting returns. So we'll weight these signals in a way that's company and country and sector specific. And the output of that second step of evaluating the stock on every one of these factors is effectively a forecast, a view that tells us our view for, tells us our outlook for the company relative to every other stock in our 15,000 stock universe. What is this company's performance likely to be? And again, it's based on that holistic assessment of company fundamentals. So we've got, at this point, a forecast for every single stock in our universe. We'll overlay on that our forecast for its market. What's our outlook for Brazil, for Nigeria, for Vietnam? We'll overlay that macro view. And it gives us now a single figure for every company that includes a macro view on the forecast for that company over the next 6 months. What are the returns likely to be? Highly systematic approach will take that forecast and utilize an optimizer. I mentioned this before, where our objective in building portfolios is literally to maximize returns subject to transaction cost and risk control. So you mentioned before screens. We have not screened out any company at this stage because of some sustainability-based consideration or any other. We have evaluated every company on its SDG alignment, on its governance profile, on the climate technologies that it's utilizing. So we've incorporated this signal across the board. But in portfolio construction, we're using that single forecast for every stock, asking the optimizer to maximize returns, applying stock-specific transaction cost, ensuring that there's risk controls at the country level. In emerging markets, greatest source of risk is country risk. So ensuring there's ample country diversification, sector-specific risk controls, controlling for size, controlling for beta, controlling for kind of some of these known measures. And of course, at this point, ensuring that we're not investing in companies that have human rights abuses associated with them, that are not aligned with the UN Global Compact. We won't invest in tobacco producers. We do ensure that the portfolio is future fit in that it's got a lower carbon profile than the benchmark. We see those types of measures as really risk controls. And the output of that is what is deemed to be the optimal portfolio. We will have myself or another portfolio manager or researcher ensure that portfolio, that trade list effectively, aligns with fundamentals, aligns with our market views. And then that's a portfolio we look to invest. We truly believe in these systematic methods, not only to forecast returns, because we've informed the model with what we think are the return drivers, but also to utilize discipline to make the right calls on this is the buying opportunity and this is the selling opportunity.
What is your average hold time for stock?
Yeah, it certainly changes by market. Like I said, China is a much faster market than the African markets. It's kind of a case example. So it will vary by markets. I'd say on average, it's about 12 months, and the range is somewhere between 3 and 24 months.
How do you measure impact in the end from your various investments.
Right, right. That's one of the sort of perennial objectives of being an alpha and impact oriented investor is how do you report this not only to our investors, but also to ensure that we're prudently managing the strategy. One of the benefits of using a systematic approach in the sustainability space is measurement. We've measured on the way in. We know on the way in what are companies' alignment to the various themes I've talked through. So on the other end, once we have the portfolio constructed, again, what I think is pretty novel and exciting for a systematic investor is the ability to show what is our exposure to these themes, just like we show our exposure to value or our exposure to growth. We can show our exposure to these various ESG signals. And more importantly, perhaps, we can show the contribution. So just like in a traditional Brinson report, you can see how much exposure did you have to China and how much did that pay off for you. I think most systematic investors can say how much value do you have in your portfolio and how much did that pay off. Similarly, in our strategy, we can say, well, how much climate alignment did we have? And was that rewarded by the market over the last whatever period, 3 quarters, 6 months, last year? To be able to show the exposures, the allocation effects, the stock selection effects, and the contributions, I think is relatively unique. Now, that's on what I consider kind of the old school. I know SRI is where we all started, exclusions-based, and the movement was toward ESG investing, thinking about what are these risk factors or alpha factors, that ESG integration movement. I think we're still there, quite honestly, as much as people don't want to say the word. But as a systematic investor, to me, that feels like a nut that can be cracked somewhat readily, that if you've got good data sets, you know how to utilize the data sets, you can do the reporting on it. The next stage in the sustainability movement, I think from SRI to ESG, it's really around impact and around that case around intentional investing. And I do think on the impact reporting side, there is no standardized approach to reporting just yet. We do look to see, to ensure that our alignment to the themes we're targeting is there so that we are SDG aligned, for example. We heavily track our stewardship activities to ensure that the stewardship collaborations that we're involved in are progressing in line with our objectives. And ultimately, I think this is a space that continues to evolve, and we are really pleased to be early movers in the impact reporting space.
I think your entire thesis is predicated on discovering undervalued opportunity in the emerging frontier markets. So tell me how you discovered the next great thing in Saudi Arabia.
Yeah, so it's fun to talk about some of the countries that we've had meaningful exposure to and how that's played out. I mentioned China a while back and the ability to launch the China fund while it was going through not just the trade and the tech war, which was less exciting. The more exciting part of it was the liberalization and the fact that this vast, inefficient market was coming to market. Saudi is almost that story all over again, but perhaps, ironically, a more successful version. I started covering Saudi Arabia in 2010, 2011, 2012. The market was entirely closed to investors at that time. UAE and Qatar were just on the minds of investors because it had, Dubai obviously had quickly risen as a financial capital. It was a well-recognized stopover for international travelers. I'm sure you've been through Dubai many times, Scott, your journeys across the globe. And at that time, those two countries, UAE and Qatar, were upgraded, or were announced more specifically for an upgrade by MSCI from frontier market status to emerging market status. This was 2012, 2013, and it was an incredible event for frontier and emerging market investors. It was the first time in MSCI's history that they had ever upgraded a country from frontier to emerging, and the results were incredible. So UAE in particular, from the time that MSCI announced the event to the time that they implemented it, there was literally a 99% market return. So investors who were in UAE at the time of the announcement, who stayed in the market, pretty much doubled their investment in a 1-year period. I thought this was incredible. I'd been following the trend for some time. It was the first time MSCI had ever made that upgrade, but S&P, another major benchmark provider, had done it in the past. And it was a trend that I was following and really excited to see it realized. But I was covering Saudi, and Saudi was entirely different. UAE was modernizing so quickly. Even Qatar had just been awarded the World Cup and looked to be kind of a leader across the globe, a cultural icon of sorts. And Saudi was kind of still stuck in the distance. I put boots on the ground for the first time in 2012. I had a 1-year-old at the time, and I felt it was important to visit this market. I was so intrigued by it because it's huge. It's much more significant than the rest of the Gulf markets. In fact, than all of the other frontier markets combined. The liquidity of Saudi was more than twice the liquidity of all of the other frontier markets combined, which is why it was never part of the frontier markets index. So I was really intrigued by the breadth and the scale of this country. I had a 1-year-old at the time, really wanted to visit. Thankfully, my husband has a travel bug. He agreed to come along as the traveling nanny. Not the nanny, but the nanny. He took care of my son while I visited companies. And perhaps even more fortunate than getting to bring my family along with me was I got to get into the country. Turned out at that time there were no tourist visas whatsoever. And certainly even on a business visa, a woman couldn't enter alone. A woman needed to be escorted. So thankfully, my husband came along and I could get into the country. I was appalled. The state of development aligned with my experiences in India, what we were talking about early on, rural India. It was nothing like Dubai. Even the sanitation levels were consistent with what I had experienced in rural India decades ago. Despite this, I just had this notion that change was underway. I could see the Gulf liberalizing. I saw the scale of Saudi. I heard about expats coming into the country, and I was really intrigued to learn more. It continued to be a hurdle to be a woman in this country. I had to wear the abaya, the headgear, and the full dress. And in Saudi, it's very different than in the rest of the Muslim world, where it's not just a headscarf and a covering, but it's literally black. It has to be black. In other parts of the Gulf that require standards like this, you can wear purple, you can express yourself. But in Saudi, it's literally black. And it was repressive, right? To feel covered all the time. And I'm not very skilled at wearing the headscarf. It was embarrassing to be a woman. And often I would visit companies and I would be singled out. Why is she here? And does she need to be here? And doesn't she know that the women work in the other office? But of course, the leadership was in this office. And once again, thankfully, I was always escorted by a broker who happened to be a man. And so I would find my way into these meetings. And I truly heard, being there on the ground, what I envisioned to be real was coming to life, that expats were moving there. They were watching the liberalization of the UAE. They wanted to modernize. They wanted to become part of global capital flows. They were opening up the market. In fact, they moved the weekend schedule. So the Gulf is Friday, Saturday. Saudi used to be Saturday, Sunday. They moved the weekend during this period while they were talking about upgrade. Can you imagine just changing the weekend? It's no longer Saturday, Sunday. It's going to be Thursday, Friday. They changed their weekends. I can't say with certainty that it was because they wanted to liberalize economically, but I think directionally that's in line. They brought NASCAR to the country. They brought Frozen as one of the first movies that they allowed people to watch in a public forum. This was a country that was liberalizing not only financially, but socially as well. And this was at the time, a really tough position to take because, of course, the headlines were terrible. Khashoggi was all over the headlines, and MBS, this young, charismatic leader, was made out to be certainly a villain, and there was real headline risk that validated that thesis. But my view is this is a market that's going to open up. Again, it brings the scale of more than twice the liquidity. It's going to follow in the footsteps of its other Gulf neighbors. Saudi certainly doesn't want to be the laggard relative to UAE and Qatar. I took the uncomfortable step of making an overweight to the country in my portfolios. And time again, Saudi took those steps toward liberalization, opening the markets toward foreign investors. They did the unthinkable when they liberalized Saudi Aramco. which was once considered the crown jewel that would never be IPO'd. Largest company in the world was IPO'd. And like I say, not only did it pay off from a financial perspective, but it just speaks to the incredible social liberalization that's happened there as well. One of my colleagues is Saudi-based, and she talks about women in Saudi Arabia, these, repressed women that we read about and that we can often sympathize with. They've got tattoos of MBS on the back of their necks. Just experiencing this incredible social liberalization. So that's an example, I think, of how, systematic tools can help us pick the right stocks, but you need people on the ground. You need people to understand these markets to pick the right countries.
Do you do shareholder engagement? And if so, what's your approach?
Yes, we do shareholder engagement. We do, proxy voting, of course, is one means. Collaborative engagements I've talked about before as an important pathway for us. We will reach out to companies and connect with them individually in the context of not only engaging on best practices and as we talked about, data and transparency, but it also helps inform our investment process. By getting to know companies, it gives us better indicators on what factors we need to add into our model. But I think collaborative engagements, just the power of these coalitions, cannot be understated. When you aggregate AUM, number of manager names, the breadth of these investors combined with each other, I have found time and time again that collaborative engagements are the most powerful, if not the most resource efficient, but even that aside, powerful tools on encouraging companies to take action. So we are actively involved in collaborative shareholder engagements on themes related to human rights and the just transition.
Do you have an example where you engaged with a company and achieved an impact result?
Yeah, some of my favorite examples on achieving results really come from the system space or come from making changes at a higher level where it's less company specific. I think company specific movements are very significant because it, creates a case example that other companies can follow in. But our objective here at Global Delta is really at that systems level where we're looking to improve the standards and improve the investability of emerging markets more broadly. And some engagements that we've had outside success with speak to more of that systems level impact. So I mentioned Saudi Arabia, working with regulators to help define what does the sustainability stewardship look like? Which measures need to be disclosed in financial statements? Perhaps a highlight with respect to our engagement work has been our work with the UN SDG working group and working with multilaterals, data providers, investors, allocators, companies to define, what are the SDGs that we believe are investable from an investment perspective. Of course, the SDGs were not, created to align with investment standards, but as investors, this creates real opportunity. And so one success I can speak to is sitting on that SDG working group and defining, here are the pathways that investors can help fund the SDGs. And again, that speaks to the genesis of Global Delta and seeing the SDGs as a pathway to growth and really targeting those themes in our investment strategy.
Let's talk about risk for a moment. You're investing exclusively in frontier and emerging markets. I often call these funny places where very often the rule of law isn't always the rule. In fact, corruption is often on an industrial scale. How do you manage your risk there? And you also have concentration and liquidity risk. How do you manage risk?
Yeah, thanks, Scott. It's truly an essential question. I alluded to this in one of my prior comments where I said in emerging markets, the greatest source of risk far and away is country risk, whether that's measured by currency risk or political risk, sociopolitical or geopolitical. What will make or break a portfolio oftentimes is that country level exposure. And so managing the country risk considerations is really paramount. And there are many strategies we have, but the one that I think is worth just really emphasizing is diversification. It sounds simple, but it's simple because it's effective. We force diversification into our portfolios. We're able to do this in a way that isn't alpha degenerative, because we have such a broad universe of companies and a broad universe of countries. So, we can limit our exposure to certain countries and make up with it with exposure to countries where perhaps, a fundamental investor just wouldn't have the bandwidth to have the boots on the ground. So the fact that we cover every country ensures that we have breadth of country exposures in our portfolio. So diversification, it's a simple tool. It doesn't require much knowledge of rule of law and corruption and the other measures you mentioned, but it's extremely effective. The other measures you mentioned are incredibly important. And I'd say they're the data accuracy, the data integrity on these types of measures is strongest at the company level, and it's quite robust. I think of these as, many kind of governance level considerations. And there are many ways to extract this data. One, we talked about natural language processing and reading the headlines and seeing what does the news flow say about these companies. That's effective, but it's also, a matter of looking at the accounting statements. The reality is in emerging and frontier markets, the bulk of the companies are actually evaluated by the accountants that fall from the Big Four. And so the accounting measures, the accounting statements are pretty simple to parse because they align with Western standards for the most part. And looking for measures of governance quality give us some insight on how much can we trust these financials and how much can we trust this management teams. In a sense, it gives us a view on whether we should downweight our forecast for that company. So diversification, company level measures, and then of course, there are limits to what models can do. Emerging markets are rife with market interventions. Market interventions can be incredibly positive for investors. I talked about the UAE, I talked about Saudi. When companies liberalize, that can be an alpha opportunity that merits an override to the portfolio, merits overriding what the portfolio, what the optimizer wants to do. But it can work the other way as well. And so I meant, you call it rule of law, I call it nationalization risk. So the example in Argentina, when the structure of the economy is just not aligned with the interest of minority shareholders or the private sector, we need to take action. And so that's, the role of the human in changing the constraint to limit how much exposure we will take. Turkey and currency risk, or China and suspension risk. There's no shortage of examples, but time and time I think of how do you know when to override a model. It's not about following the news necessarily, because most of the news is simply related to headline risk and doesn't actually translate to direct economic risk. So how do you know when, a rule of law or corruption consideration is truly going to impact the companies that we're investing in or the economies we're investing in? In that context, we look at what interventions are occurring at the equity capital market level. So I'd say between the humans and the data and the magic of diversification, these very real considerations can be managed.
You mentioned most of your investors are institutional investors. What are these investors looking for, and have your investor profiles changed over time?
Yeah, it's truly been a journey. And I know, Scott, you're a founder. You know what entrepreneurial life is like. You asked me earlier, why take this entrepreneurial route? I think you really got to love the process. I think of it as very much a labor of love. It's one of the most exciting things I've ever done, and it's been quite challenging. To clarify, we got those founding documents in place in 2020, but our fund itself is certainly younger than that. We spent a good bit of time testing our models and ensuring they were robust enough for institutional capital. In terms of the fundraising journey itself, we've had the great fortune to work with investors who knew us before, who understand our investment process, understand the strengths, the pitfalls, the opportunities of the strategy we're investing in. But I'd say where we've had traction beyond the fact that it's investors who know you. I've always heard this, that the investors who will back you are the ones who know you best. But it's particularly on the impact side. Investors who are looking for that kind of real junction of how can the investor, how can an allocator achieve both alpha and impact. There seems to be tremendous hunger for, investment strategies that are able to deliver on both, recognizing that impact in and of itself is nebulously defined today. but there's movement around intentional capitalism I'm not seeing die down in any way. In any way, it's only become, more ardent in the backdrop that we're investing in.
A couple of years ago, you wrote a book called The Power of Capital. I guess that could be described as how investment capital is transforming the world's most critical emerging markets. Maybe you can tell me a little bit about the book and then how you discovered the power of capital in Kenya.
The book is Power of Capital. You've said it. You've summarized the intention of the book very well. It's to talk through how investment capital can literally build ecosystems. And in fact, there is a dual purpose of capital. It is both to generate returns for investors, but also to fund the ecosystems in which we want to live. You mentioned my self-acclaimed title as an adventure capitalist. I, of course, did not create that title. I don't know where it came from originally, but I think of the original adventure capitalist as Jim Rogers, who wrote a book by that name, Adventure Capitalist.
I know the book. I actually read, he made two of these books, one on a motorcycle, he went around the world, and another one where he drove around the world.
That's exactly right. So Adventure Capitalist was in the Mercedes, and Investment Biker was in the motorbike.
Oh, yeah, that's it, yeah.
He's a phenomenal storyteller. One of the great accomplishments of my book, Power of Capital, is his endorsement. So he actually endorsed the book. And I bring him up to say that he very much inspired not only my career in emerging market finance, but my decision to write a book about adventures around the world. Reading his books early on inspired me, again, not just to invest, but to write as well. And so my book, Power of Capital, I'm not as good a storyteller as Jim is, but it tries to go in that direction. It's a walk around the world. I walk investors from China to Vietnam to Saudi Arabia, Romania, which we've talked about, back to India, Africa, Latin America, and talk about, as you mentioned, the critical drivers of these emerging markets and the opportunity for alpha and for impact for investors across the globe. We've talked through the power of capital and many examples of how investment capital can transform lives. Microfinance is the original impact investment I think of. I talked through how when we would give these single rupee loans to women, that we were literally building the foundation of India's economy, which is kind of incredible. Today, the third largest economy on earth. Talked about Saudi Arabia and how this very, very wealthy country did so much to revise its market standards to get into the global capital flow. I think that's such an interesting story, because why does a wealthy country need to emerge? It's to get access to knowledge, to credibility. We talked about Romania and the power of capital, especially equity capital, market capital, in improving transparency and stamping out corruption. In Africa specifically, I talk about the very basic notion of investment capital, literally building infrastructure and funding innovation. One of my first experiences in South Africa, I remember being in the back of a cab, and I could smell the scent of kerosene coming from the back seat. And it reminded me of being in my grandmother's home as a young girl, 5, 6, 7, one of my earliest memories. And she would cook rotis or cook bread on a kerosene stove. I could smell that coming from the back seat or the trunk of the car. And I asked the driver about it. Of course, I knew kerosene was typical in South Africa. It's typical of any market that is accustomed to rolling blackouts and electricity shortages. It's a way to get fuel in people's homes. He kind of looked at me with a wry smile and he said, "Miss Asha, do you know what they used here in South Africa before we used candles and kerosene?" Kind of perplexed, and he said to me, "We used to use electricity." And it's kind of one of these case examples of corruption, as you mentioned, of how infrastructure in many of the emerging markets is limited because of the governance profile in these countries. I bring up this story only to say that there is a tremendous power of capital in funding innovation and financing innovation and infrastructure that I think its neighbor Kenya really beautifully highlights. From South Africa, I went up to Kenya. I went to the Great Rift Valley and learned about how Kenya has harnessed the power of thermal energy to nearly fully electrify the country. Thermal energy in Kenya today took electricity access from about 50% to 75% of the country's population in a period of 5 years. It made Kenya one of the top 10 largest thermal energy producers in the world. It's available 24/7 to Kenyans today. And it was investors who funded that capital. Investors who were early on in those projects were rewarded with a 50% investment return. And that's the thesis around power of capital, that it's not concessionary. We can build a sustainable environment and we can make a return along the way.
You get around to a lot of places that most people don't. What's the next great emerging market?
The next great emerging market. I've got a heavy travel list ahead of me. We could talk about the next great emerging market in terms of the next country or the next region, and I'm happy to do so. But I want to broaden the conversation a bit. Next on my list is Indonesia, Vietnam. These are countries where we have overweights and where I just think there's, again, such a robust opportunity in terms of breadth of securities listed, undervaluation, strong disclosure standards. But I also think in the context of emerging markets, it's important that we realize that we increasingly live in a borderless world. I think of Mercado Libre, a very successful tech company that, in many ways is larger than the country it itself is traded in Argentina. So if you think about countries or opportunity sets as broader than countries, I extend the answer beyond the ASEAN market specifically, Indonesia, Malaysia, Vietnam. I've mentioned the SDGs as a pathway that we're following, but ultimately we're looking for sectors or parts of the market that are underrepresented, undervalued, that have proven potential. And so one of the themes we're following, if we kind of rip up this notion of a country, is this idea of women as the largest emerging market in the world, women representing actually the bulk of the world's footprint. More than 50% of the globe is comprised of women. Certainly undervalued, as many of the statistics show, whether that's with respect to pay parity or others, and with proven potential. Just a generation of investment in education of women has been made in India, in China, across the emerging markets, and of course in the developed markets as well. And so that thesis around underrepresented, undervalued, proven potential, I think plays out in the context of women, which is another theme we're following.
I spoke with Chris Ailman a couple of weeks ago at CalSTRS about managing his 300 billion plus portfolio. And he says, people ask him, how do you sleep at night? And he said he sleeps like a baby. He wakes up every 2 hours and screams. What wakes you up at night?
I'm really passionate about the strategy we're investing in. Again, I spoke over and over about the alpha opportunity and the impact opportunity in emerging markets. We've talked about the risk profile of countries that we're investing in and how the greatest source of risk is country-specific risk. I'll talk about the country that I find most challenging today to discuss and in some ways to invest in, but I want to talk on a couple levels. Of course, China. You brought it up early on, my experience in launching the China fund with this incredible opportunity of the breadth and liberalization and yet the geopolitical headwinds facing the country. All of that has played out. This is a country that has underperformed over the last few years as a result of self-inflicted practices and as a result of, the Western world turning more protectionist. So there's a couple issues with respect to China. One is tactical, one is strategic. At a tactical level, when's the right time to buy? When's the right time to say, hey, valuation is just so attractive today. And yes, the headline noise is significant, but headline news is just news. There's that tactical question around when is the right time to make a China investment. And I'd say on net, we actually find China and the market interventions it's making today as potentially creating a buy opportunity. But I think the broader and more strategic question for investors, especially in the sustainability space, is around recognizing that this tactical question is going to pass. The reality is that China is a leader on technology. China is a very robust economy. China's leadership is extremely deliberate and methodical in terms of its pathway to growth. And this is, 3-4 years, just a small blip in its broader pathway to maintaining its position as a significant country on earth. China is a huge funder of development. It's built the One Belt, One Road pathway. And today it's a significant lender across the globe, not only in emerging markets, but developed markets as well. It's a funder of the SDGs, sits on the Human Rights Council at the UN. And as China emerges and I'd say, advances a policy playbook that's quite different from the West in many, many ways, but one of the ways being that the West is turned more protectionist and China remains expansionary. What does that mean in terms of sustainability? What does that mean in terms of how technology and AI is advanced across the globe? How do we, as Western investors, feel about China developing many of the AI strategies that are being adopted within Africa and within other markets that are looking to leapfrog ahead? China's practices, the autocracy specifically, have been condemned over and over by the West. And I think about what's our role as sustainable investors in ensuring that we have an international footprint, because ultimately it will be China that is funding the rest of the globe and advancing not only its own financing objectives, but its views on what does social and human progress look like. So to the extent that we want to, remain prominent in our views around freedom and human rights, I think there's significant importance for sustainable investors in advancing their objectives, not just here in the US, but with a global mindset as well.
If you had to name the single most important challenge in the sustainable frontier and emerging market public equities market space at this time, what would it be and why?
Funding for the SDGs, greatest challenge.
What do you know now about sustainable public equities investing in frontier and emerging markets that you wish you knew in 2007 when you showed up at Acadian?
I think in many ways I was fortunate to be naive and to see this pathway develop. I just see the opportunity today as vast. Perhaps if I had understood the growth pathway of sustainability and the growth pathway of the emerging markets, perhaps we would have moved faster on this opportunity set around sustainable investing in emerging markets. But it's been a journey and no regret.
You don't have to name names, but can you describe an example of an investment that you were convinced of at the time you invested, that it ticked all of your ESG sustainability boxes, but in the end, it didn't turn out? And what did you learn from that experience?
I think the importance of being a value investor. India is a beautiful example of a country that checks all the boxes. Its pathway to development. We've talked about microfinance as having built, the sector set that exists today, its advancement. I didn't focus as much on the advancement of women, but I referenced a generation of education investment in women. I think India's been a terrific investment over the last couple of years, but over the longer term, it's been a tougher investment in part because of the valuation. So I think it speaks to really having that breadth of coverage and understanding that it's not just about the sustainable objectives and the growth objectives, but having that value mindset is critical as well.
Now, the converse of that, can you describe an investment that you were skeptical of, either at the time you invested or maybe you passed on it, and in the end, it really turned out way better than you thought, and you were pleased you invested, or if you passed on it, maybe you wish you hadn't? And what did you learn from that?
This is probably repetitive, but India over the last couple of years, I think much of the strength of India more recently has been a result of the blowback against China. And so again, those fundamentals in India are just very, very strong. It's remarkable. Over the last decade, the country has become banked. The country has gone from 1/3 of the population having access to a bank account to 3/4. And what's shocking within that is not only just the vast growth, but the fact that what was once unequal access to banking across the genders, that gap has completely closed. So across men and women, access to bank accounts is on the order of 3/4. The fundamentals are incredibly strong. The valuations are incredibly high. So it's been a difficult investment for the last couple of years from this multi factor approach. And yet it's a country that's done incredibly well. And so, knowing how to time these investments, I think, is part of the challenge and part of the opportunity.
If someone wants to get into sustainable/ESG public equities investing, specifically in frontier and emerging markets, how would you advise them to get into the business, and what would be the best place for them to cut their teeth?
I think just getting your hands dirty in any way. This is a very narrow space. Increasingly, it's growing. Scott, you mentioned many funds that are investing across emerging markets. And, even the larger shops typically have emerging market strategies today because it's become more of a mainstream asset class. So for investors or individuals who are looking to get in, I would say just stay true to that passion. Developed markets remain a very large investment opportunity, and so to find that EM role can be more limited. But, I think I was fortunate early on to understand that was something that was important to me. So I would recommend individuals who are looking to get in to really just stay focused on that passion, understand that you might be in the minority and opportunities today may be more limited. Again, the U.S. had an incredible period of performance over the last decade, and emerging markets have lagged relatively. But to find a way in, whether that's, in a research role or an operations role, and just get your hands dirty, work with the data, get as much experience as possible.
Asha, you've been very generous with your time, and I think we've gotten to the finish line, at least from my side. I've really enjoyed it. It was great talking to you. Is there anything that we didn't get to or didn't cover that you wanted to speak about?
God, this is great. We have covered so much ground. Thank you. I'm all set. We've covered everything I intended to and a little bit more.
We do seem like we've been around the world a little bit. Thank you very much for taking me through all this. I really appreciate it. I've learned a lot. Now tell everyone about your websites and social media and all that good stuff. Yeah.
Scott, thank you so much. It's been so much fun to take a walk around the world with you. I've really enjoyed this conversation. Would love to stay connected to your listeners. Please feel free to check us out at globaldeltacapital.com or learn more about the book at powerofcapital.com.
And what's the best way for people to contact you?
Find links on those websites to contact me or reach out directly by email, Asha, A-S-H-A, at globaldeltacapital.com.
We'll put all that in the show notes. Okay, Asha, thanks again.
Scott, such a pleasure. Thank you. Really an honor.
All right, goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.